Hello, my name is Mark Rigney and welcome to Mortgage Solutions. Today we're going to discuss something very important to today's consumer, and that is your credit report. If you've ever bought a car, owned a home, or just used a credit card to finance a purchase, then you have a record with a consumer reporting agency. Keeping your credit reports healthy and positive can help you save thousands on life's big purchases. A credit report is a record of your financial behavior that is kept by credit bureaus and provided to businesses when they want to evaluate you. There are 3 national credit bureaus that maintain credit reports on you: TransUnion, Equifax, and Experian. On today's show, we're going to speak with a credit report expert, Jim Perkins. Jim, who has over 20 years experience in lending, and I are going to discuss and give you tips and steps you can take to maintain your good credit, improve your credit score, dispute errors and inaccuracies. If you have questions that we do not cover, please feel free to email us. Our email address is mark@markrigney.org. We will read some of your questions on the next show. Hi, Jim, and welcome to the show.
Hey, Mark, how are you doing today?
Jim, what do you think is the one most important thing a consumer can do to keep their credit report healthy?
Probably one of the most important things that a consumer can do is check their credit report at least once every 12 months. They can do it more often if they would want to, but there's a free there's a website that the government has sponsored. It's called annualcreditreports.com, and all 3 of the credit reporting agencies are located there. They're required to give you at least 1 free credit report every 12 months. Now, they have many other services that they offer there, but they'll charge a fee for that.
On that website, annualcreditreport.com, if a consumer goes to it, can they actually view their credit scores?
Well, they won't give them the credit scores right there for free. They'll actually charge them a fee, but they can have or get access to the credit scores. They also have programs like credit monitoring, or if you have issues or concerns about your credit, disputing things on your credit report, some of those things can be taken care of right there on the website.
Mm-hmm. Jim, who actually uses these credit reports?
Well, it used to be that lending institutions, like if you were getting a car loan or you were getting a mortgage, that they were pretty much the only people that used the credit reports. Now, with the advent of the credit scores, what you're seeing is insurance industries are using those, credit utility companies, your cell phone provider is using those, your mortgage lender, car dealers, anybody that is extending any type of credit or offering you a lot of times a service is going to pull your credit and verify the credit information. A lot of times what they do is they'll verify the information that you've given them on an application or information that you provided against the information that's on the credit report.
Mm-hmm. And what exactly is enclosed in a credit report? What does that contain?
Well, that's a big question. There's a lot of things that are contained on a credit report. It starts out with your basics. It would be your name, your address. It'll have previous addresses. It'll list on the credit report. Then they go into employment, and then your previous employment, and it goes back a number of years on that. They have on the credit report that we get as a lender, you'll have your Social Security number, it'll have your date of birth, it'll have information as far as verification of the Social Security number. Are there any issues with it? Are there any inquiries on your credit? Who's been inquiring on your credit? And then the basic thing of your credit. How your payments have been made on your accounts, any 30, 60, or 90 days late, or things that are collections or judgments, and public records, which would be the judgments or bankruptcies, foreclosures, those sort of things. Anything that would show up on the courthouses.
Right, right. What exactly are credit scores and how do they work for a consumer?
Well, what a credit score is a predictor of how you're going to perform on a payment or an obligation in the future. So the higher your credit score, when a lender is looking at this, it's an indication to them of how you're going to make the payments, if you're going to have issues or problems, or if your payment history is going to be good. Now, take in consideration that it's not directed at the individually, personally, like they don't take in consideration your job or how much money you have in a bank or your nationality. They're just taking the credit profile and matching it up against a statistical database, and based on how it matches up, you get a score. And that score is what they call your credit score.
Mm-hmm. When a lender's trying to extend you credit, what are lenders looking for in a credit report exactly?
In a credit report, well, one of the things that they do that they didn't used to do as much, but one of the things that they do right now, and I made mention of this at the opening, was that they will look at the information that you provide. So if you're providing a mortgage application and you're providing previous addresses or previous employment, they're going to match that up with what's on your credit report. And if it's different, they're going to question you on that. They're looking at other things on the credit report as far as your payment history. Have you been late, 30, 60, or 90 days late? Now, a lot of people say, oh, I made my payment, it was late, am I going to show up on a credit report? It only shows up when I say 30 days late. It means that it has to be 30 days past the due date before they'll report it on the credit report. So even though, like say on a mortgage, it's due on the 1st, you have to pay it on the 15th, by the 15th, and you could get charged a late fee. But you could pay it on the 25th and still not get reported to the credit reporting agencies as being, 1 times 30 days late. If it's more than 30 days late, it goes 60 or 90 days.
After the 15th of the next month, right?
Well, no, because it's due on the 1st.
Right.
The 15th, 1st to the 15th is a grace period.
Right.
So it would be after the 1st or the end of the month, then it's considered 30 days late. So they're going from the 1st. And a lot of people make that mistake, whereas they'll think, well, I've got to the 15th, so I got to the 15th of the next month. So if you paid it the 7th of the next month, it's going to show up on your credit report as being 30 days late. Yeah. So that's something that you got to be careful about.
Okay. This nation is having a lot of difficulty with credit cards and drowning in credit card debt. How do credit card balances affect the credit score and credit reports?
Well, this is one of the kind of a factor that a lot of people are not aware of. What they call revolving credit. And what they do is they look at your overall available revolving credit. So say if you had 2 credit cards, and each credit card had a limit of $10,000. And then on one card you had a 0 balance, and then on the other card you had a $3,000 balance. They would look at the ratio of the $3,000 to the total available of $10,000, which would give you a ratio of 30%.
Right.
Anytime that ratio goes over 20%, it starts to ding your credit score.
Really?
Now, so some people will say, well, I never used that card. I'm just going to close that one that has a 0 balance. Just by doing that one little action, you've eliminated $5,000 of your available credit. So now your ratio is based on 3,000 of the 5,000. And what you've done is doubled your ratio from 30% to 60%, which is going to have a dramatic impact on your credit scores.
So closing a credit card could actually decrease your credit score?
Just by doing that could do that. Now, let me explain to you the thinking or the reasoning behind that. It's one of the factors that make up the scores, but it can be an important one if your ratio is very high.
Right.
But say if everybody in their life will have some type of life circumstance where something happens, they lose a job or their income dramatically drops. Well, if you're at a low ratio on your credit, like say you're at 10%, and remember the scores are predictors of how you're going to perform on your credit in the future, your payment, how you're going to perform in your payment. So if your ratio is really low and say you lose your job, well then you can live on credit for several months and still be able to make your other payments, then get back on your feet, get a job, and it hasn't affected your payments because you're living on that other 90% of available credit. But if you're right at, say, 90% of your available credit and you lose your job, well, you have got no place to go as far as getting additional cash, and you're going to run into problems as far as making payments on your credit. So that kind of gives you an idea of how that predictor works. So when you're looking at your credit, that's one of the things you want to make sure. You want to make sure that you keep that ratio below that 20%. You should be in good shape.
Okay, that being said, if a consumer were to go out and open another revolving account, will that actually increase their credit score because they have a credit card with a 0 balance and say a $10,000 limit? Will that increase their credit score by actually opening a credit card?
Well, it depends on the rest of their credit profile, but eventually that will have the effect of increasing the credit score because that ratio will be lower. Now, normally when the ratio is high, banks are not going to extend you more credit because they feel that the person is having trouble because they're living on their credit already, so you may not be able to get that extended credit. Another way to do it is just call your bank and ask them if they'll increase the limit on that. And that can have a dramatic impact very quickly because if you're going from, like, say, an 85% ratio down to a 10% ratio, then it can make a big difference. And it's a ratio that they're looking at. They're not looking at, say, I got 100,000 available and I've got 50,000 to choose. I still got another 50,000. They're looking at that is like 10,000 and 5,000. So it's the ratio they're looking at.
It's not the actual dollar figure, it's the ratio.
Exactly, correct.
Do you think it is a good idea for a cosigner on a credit card, or what are the effects of that?
It really depends on the circumstances. You really have to be careful if you do cosign for somebody, because basically what that means is that the bank or the lending institution will not approve them. In other words, they don't think their credit profile is good enough to be on the account by themselves. So for a parent co-signing with a son or a daughter or a child, that they're going to allow them to use a credit card maybe at school or something, that's circumstances that I think are probably acceptable in most cases. But you got to be careful how they spend it, because it's going to be showing up on your account. You're going to be held responsible for it. But if it's somebody outside your immediate family, like a cousin, a nephew, or even a friend, you have to be very careful, because if they don't make the payments, then it's showing up on your credit report.
Would that consumer be given an opportunity to make that payment before it showed up on the credit report?
Generally speaking, not. It's something that happens automatically. So what will happen is the person they're living at a different address than you are, that account, if they're the first person on that account, it's going to go to them. And if they decide that they're not going to make payments or they miss it, then before you know it, it shows right up on your credit report. So you got to be very careful of that. I've heard cases where somebody has co-signed on a mortgage and they didn't even realize that the mortgage was in delinquent until it went to foreclosure.
Okay. Do the more forms of credit you have extended to you affect your credit score? Could you be overwhelmed in too many obligations?
Well, that's one of the things that they're going to look at. So you got to be careful that you don't get too many, but it doesn't have a dramatic impact. You got to be careful how the credit is structured, you know, how much, your ratios like that. But you can have multiple mortgages, you can have multiple, car loans, you can have a number of credit cards. You just got to make sure that the profile fits within the guidelines.
What are the effects of a divorce on a credit?
Now that's something that we see a lot, and that people that are going through this type of situation want to be really careful with. We see in a lot of divorce decrees and separation agreements that the one spouse has agreed to take over the payment of the house, and then the other spouse assumes that they are not liable for that mortgage note or whatever. It could be just a credit card, that they're no longer liable for that because they've, in the divorce decree or separation agreement, they've acknowledged that the other person's going to take care of it. Well, what actually happens is that divorce decree or separation agreement is actually a civil action between those two people. It really has nothing to do with the bank. The bank still has you signed on as far as a person who's obligated to make that payment. And so if the person that's agreed to make the payments doesn't, then they can come to you, and more than likely it's going to show up on your credit report.
Regardless of whether a judge says, hey, this is not their debt, this is the spouse's debt, that does not matter. It can still affect your score.
Because it doesn't get to the point to the judge. The credit reporting agency is getting the information from the lending institution or whoever's reporting it, and they're saying, hey, we haven't gotten the report, we haven't gotten the payment. It shows up on the report as being late, and whoever's listed on the obligation is going to get hit on their credit report because they got your Social Security number, so they're going to report it. So the best thing to do under those circumstances is to make sure that the individual is released from the liability. So in the case of a mortgage, you'd want that person within a certain time frame to remove your name from the note. Once you're removed from the note, then you're released from liability.